Hey guys, Jason Schnitzer here, and what I've got for you is how's the real estate market for week 9 of this 2023 real estate market. As always, I like to start with stats. We have just over 2,200 homes for sale here in Orange County, California. 219 new homes for sale and 344 have gone pending in the last week. The biggest change since the last time I've done this video is interest rates. So the Fed has met for the first time in 2023. And initially they came out saying that, hey, we're gonna be still raising rates, but maybe not as aggressive. Since that talk, inflation numbers have come out worse than expected. So over the last quarter four, let's say, there's a lot of economists that were saying, hey, this inflation is starting to show signs of slowing down. Their thoughts were going into 2023, we were going to start to see inflation numbers start to quell and potentially job market start to tighten up, which is what they were hoping for with regards to raising interest rates. Well, quite honestly, the opposite has happened. There's been a positive jobs report, and there is a bit of controversy on that with regards to jobs being created. What are the quality of those jobs? And because of the cost of inflation is having on people, is this just people getting more than one job? And of course, there's people talking about like, hey, you know, transitory inflation. I think that ship has sailed, or inflation is clearly here to stay. And that is what the Fed is trying to do with raising rates. They're trying to get inflation to slow down and the job market to slow down. And we've seen both of those things actually go the other direction. So I'm really curious to see what the Fed is going to come out and say next, if they're going to attack inflation as aggressively as they did last year, that they did this year. I'll tell you what, if we see interest rates go up above 7%, like we almost did in quarter three of last year, that really hit the brakes on our market. So that's something that I'm going to keep a close eye on. There are economists out there that just think that the market's going to fall off a cliff. I'm not convinced that that's going to happen. We are seeing softening. Interest rates and affordability are the number one drivers on that, but the biggest thing that we're not seeing is more inventory. And the biggest difference between our last market crash and our market right now is a few things. One, financing is back to normal. And what I mean by that, it's a show me what you got lending market. We're not in stated financing. We don't have any adjustable rate loans. We don't have balloon payments coming up in 4 or 5 years and interest rates adjusting so that, out of interest only loans to fully amortized, anything like that. And so like what we saw back in 2007 was the market tanked and nobody could afford their payments because they had balloon payments, they had interest-only loans that went fully amortized, and that increases your payment by potentially thousands of dollars a month. So we had mass amounts of people who couldn't afford their payments anymore and had to sell. And so the market was flooded with inventory. And we know Econ 101. Right now we have more demand than we have supply. Well, back in 2007, we had more supply than demand, and we were forced into selling, foreclosures, short sales. So we had a huge impact on prices in the market. Whereas now what we're seeing is the majority of people are locked into a 2.5% to 3.5% interest rate. They're in a payment that they can afford and were pre-qualified to do so. Not only that, the other big factor was back in 2007, you could do a 0% down financing loan, finance the whole thing interest only on stated financing, which just seems absolutely crazy to me. But nowadays, I would say 90% of people, over 90% of people have equity in their property. At least for my own personal business, at least 90% of people in the last 3-4 years have put down at least 20% into that property. So if your house goes down in value, doesn't matter if you're comfortable with the payment and you like where you live. The only time you lose money in real estate is if you sell the property. So where I'm going with this is people are in their homes in a payment that they can afford, and even if the market gyrates a little bit, there's no reason for people to sell, so they're just staying put. And that's what I believe we're seeing right now with regards to inventory, because it's low, that's actually what's keeping our market going. We don't have a lot out there to buy, so there still are lots and lots of people looking to buy. They want to live the American dream. They want home ownership. They see the value in real estate and generational wealth. And quite honestly, Southern California is a pretty dang nice place to live, especially because of the big contributing factors. Number one is weather. I know it's been cold lately, but 40, 50 degree temperature is not so bad when it's only a couple weeks out of the year. You basically have 11 months out of the year where it's 72 and pretty nice. Great schools. And another thing that I've really been thinking about is, with so many people able to work from home now, we've seen it, especially people moving out of the big cities into areas like Orange County. So if we do see a pullback with regards to prices, I think it's going to be more of a area specific pullback. Affordability is going to be the main driver, but the areas that are desirable, they're going to hold their value as areas have year over year through all recessions. But anyways, food for thought. If you have any questions with regards to your real estate portfolio going into 2023, how I can help selling, buying, investing, we offer free real estate consulting. So feel free to take full advantage of that. Send me a message, call, email, etc., and I'd be glad to help. Thanks for watching, you guys. Catch you next week. Hey guys, thanks again for watching this week's episode of O.C Realtor Talk. If you gained any value from this video, we'd really appreciate it if you liked, subscribed, and followed us on all our social media platforms.